Hey everyone, welcome back to another market closing live stream. We have just 25 trading days left in the year. This is leading to a lot of hopium. Boy, that's been a bad investing strategy this year. Anyway, that we might end up seeing a Santa Claus rally at the end of this year. Now, we did have a little bit of Santa Claus last year, except it was all November, and we had very little December Santa Claus. So I wonder if Santa Claus will come around this year. Well, for student loan borrowers, Santa Claus is coming. He is coming because the Biden administration is once again extending student loan debt relief payments to June. That's because too many of Joe Biden's attempts are failing, or at least getting held up in courts, to actually eradicate about $10,000 to $20,000 of student debt relief being again held up. And Joe Biden's doing what he can, which is, well, fine. Then we just won't collect any payments. Kind of interesting, at least interest payments, that is. Anyway, what do we have in terms of the market? With 25 days left, we've got the Dow Jones up 1.14%, the S&P 500 up 129 right now, NASDAQ 125. If we look at bonds, 10-year falling a little bit, 3.76, basically where it was this morning at 377. We've got Brent still sitting at that 88.5 level, and WTI sitting at 81.19. You know, we talked about this morning about how we really want to see inflation levels come down in September here. That's going to be, I think, what everybody's waiting for. And it's going to come down to oil, but it's not moving. You know, there are reports that right now the level of short interest on oil companies is very, very high, implying that there's some pent-up belief that oil prices are set to plummet. And that'll obviously take down stocks that have performed exceptionally well this year, whether that's Exxon or ETFs in the energy sector. The energy sector is up like over 60% for the year, whereas financials or technologies. Financials positive, technology's down like 25% on average across the board, many of which down 50 to 60%. It's remarkable. So maybe that's leading to some folks layering on the shorts on the oil companies. Oil companies are still an interesting hedge if you think about it. That's one way to look at it. If you're pretty long on the stock market, oil companies, you know, they got lots of cash flow, lots of profits. A lot of people see them as an opportunity to just add a little bit to your portfolio. So that way, when your tech's getting hammered and oil's going up and inflationary concerns are rising, at least so is your oil. Of course, some folks can't bring themselves to touch oil. And I don't blame that with how much of an EV revolution we expect and a green revolution. Certainly, even oil companies realizing that now, installing charging infrastructure, wind infrastructure. Occidental, one of Warren Buffett's big holdings, looking into carbon capture technologies, and not just looking into, but actually starting to build some carbon capture plants. A lot of these experimental, money losing, though many corporations say they're interested. So Occidental's up for the challenge and is down to start seeing how much money they can make off of carbon capture instead of oil production. We'll see. Anyway, looked into the PC market a little bit this morning, and the PC market's fascinating. I have this suspicion, and we were talking about this in the course member live stream this morning as well, of this suspicion that the PC market and gaming has hit a floor that it won't necessarily. When we looked at Best Buy's earnings call came out, and they indicate that we're still expecting to see negative PC sales compared to 2021, but we're above 2020. But then you sort of wonder, like, okay, but were people just panicked and not spending money in 2020? So it's really interesting. I'm still working on more data on that, but it's a thesis that we're working on now, which is it possible that PCs have bottomed and maybe more of the commercial side is like enterprise and servers and data storage. Those are set for more disappointments than PCs at this point. I think everybody's kind of like, oh yeah, PCs are dead. Nobody's going to buy a computer again. It's like, yeah, that doesn't last forever. So we'll see. All right. Let's take a look at what we've got on some of the sticks here. We've got Facebook up 1.27 on the day here. BTC back over 16K. Let's go ahead and sort by losers and then winners. Dollar Tree down on I want to see was their forecast. Actually, I had a piece on them. Let me see here. Dollar Tree. What happened here? It's right here. The Dollar Tree report, because Dollar Tree has been one of those people have been flocking to as a tool to sort of offset, and they've done pretty well this year as a tool to offset weakness elsewhere, as people believe that, we're going to see Dollar Tree move into or become more of a staple for people. But it looks like they're getting hit by inflation. Dollar Tree, they beat Q3, but their guidance was low because of margins. Specifically operating margins. Let's see here. I'm trying to go through these notes here quickly. Okay, inflation and a mix of shift mix shift. So that's a way of saying you go into a dollar store and maybe usually you buy more expensive stuff. Now all of a sudden you're buying the cheaper stuff that has a lower margin. Some products, you can buy something because usually now what you're seeing is even dollar stores are carrying more expensive things. You start seeing companies, they sell stuff. Hey, they might sell something for $5 and make 10 cents a profit on it, but they might sell something for $1 and make 80 cents a profit on it, right? So you'd rather sell stuff for $1 and make a substantially larger profit. And so that's when they talk about a mix shift, they talk about moving to those that already have a lower margin. I'll give you an example of one that I would suspect. So let's say little toys for kids, like the super cheap little plastic toys, like the little flying discs or whatever. They sell these things usually for $1. They buy them for like 9 cents. The profit on these is freaking huge. But discount razors might only have a 5-cent margin on a 3-pack of razors for $1 or whatever. And so you get that mix shift. Now you're actually getting people not taking those discretionary cheap toys and kind of like, nah, let's not spend money on that. And it actually ends up hurting Dollar Tree. Really interesting to think that Dollar Tree could be experiencing such a shift that their margins would get impacted. But it makes sense. It's not like you have pricing power at the dollar store. I think the reason Dollar Tree has done well is because you kind of look at it as like, well, where do you go in a high inflation environment? You try to save money. So what do you do when you try to save money? You go to cheaper stores. It's kind of like what people do in life when they're like, it's so expensive. Rent is so expensive out here. Let me go move to a cheaper area. And then surprise, surprise, their income never actually rises because now they're in a cheaper area where it's actually harder to make more money. Yeah. So one of the things we talk about, for example, in the Elite Hustlers University course, which launches on Friday. So one of the things we will be talking about is actually cost of living areas and how it's such a fallacy that if you want more money, move to a low cost of living area. It's a terrible idea, horrible idea. It's exactly the opposite of what you should be doing. Anyway, so that course launches on Friday, which will be fun. But at the same time on Monday, well, maybe not the same time, a few days later, we'll be doing the trading challenge. So that'll be really fun. That starts Monday. So that'll be cool. All right. Not always true with the work. See, you got to be careful with this belief about work from home. I really believe that if you want to prove that you're a hard worker and that you can really advance in your income and career, I feel like you've got to be in person. Not true for everyone, but for most, I would say there's a really big benefit to that. I think once you're established and you have a resume and you could prove that you could do a job, that's fine. Then remote work is fine. I don't see an issue with that. But for startups, remote work is very difficult. For establishing yourself, I suspect remote work is quite difficult. Anyway. So, exactly. Like you say, you work from home for a company you've been with for a decade. Exactly. Like everybody, you're already known, right? There's no secret there. It's not like you're a brand new worker and trying to build relationships there. So that doesn't surprise me. All right. Anyway. So, let's take a listen here what we got on CNBC, and then we'll pop over to Bloomberg in a little bit.
Like Target that continues to struggle with discretionary spending. Hi, Sarah. Yes, a lot of it boils down to both inventory and execution. For Best Buy, their inventory has been well controlled. Their inventory is actually down 15% year over year, which has helped because the market for consumer electronics has softened and it's been able to better hold the line with promotions. For Dick's Sporting Goods, it has a really wide array of name brands that people are still seeking out and willing to pay up for, one of them being Nike, one of them being Titleist.
Wow.
So a lot of these brands have allowed it to have some pricing power in this tougher environment.
Wow.
And when it has had extra merchandise, it's actually moved that out to its going, gone stores, which are kind of it's off price, which has allowed it to also kind of clear out excess merchandise, keep everything looking really sharp, really fresh, keep those higher price points front and center.
The other thing, Melissa, is I feel like the common thread between all of these that had better reactions to their earnings and better numbers than expected is that they've all been really poor performers this year. Best Buy, everyone was anticipating weakness, and it's not like we're seeing strong sales growth here. We're still seeing sales declines. They're just not as bad as feared. So I feel like that has to be a theme here, is that expectations were really low and things are just coming in a little bit better because some of these companies are executing.
That's a great point. I think that Best Buy lowered its own bar this summer by cutting its forecast, so it beat that and was better than feared. With Dick's Sporting Goods, it's a little bit of a different scenario. It actually hasn't seen any trade down, not like Best Buy was talking about today. I spoke to Corey Berry of Best Buy, and she did say that there was some trade down among lower income consumers to things like cheaper TVs. Dick's Sporting Goods, on the other hand, is really not seeing that show up. It's finding that there's a lot of strength in the category still.
Yeah, well,
that's actually really fascinating to me that a company like Dick's can show that sort of pricing power. That another company that I think of when I think of pricing power is Lulu. Lulu is also a smaller company. So when you have smaller companies, you have these benefits of they haven't actually gotten to a level of sales yet where they're at anywhere close to the top of the S curve. And Tesla's another example of that, right? There's just so much demand for the product. So that's fascinating that the Dick's report was so good. It makes you wonder how Nike is maintaining that potential power. She said Nike, but the last time we looked at Nike, I don't remember seeing pricing power at Nike. In fact, I'm pretty sure I remember seeing discounts at Nike. Let me see here. I have the Nike report right here. We went through this in the course member live. Let's see. Massive increases in inventory. Inventory not selling, probably worse than the alternative. Spending a bit more on marketing and having margin decline. So trying to maintain margin. Higher mix of full price sales. So less discounting if you have full price sales. Okay. All right. That's fair. Digital marketing, strong consumer demand. This was the last. Hold on. This might not be the last quarter. Hold on. Let me make sure I have the right. That's June. Okay, that's June. Let me go to the more recent one. Yeah, I remember now. We looked at June and we looked at Q3 side by side. That's what we did. Aha. Okay, here we go. So Nike. See? This was my suspicion. This is why you keep your stuff organized. Look at that. This was Nike Q3. Gross margin decreased 220 basis points, primarily driven by elevated freight and logistics, lowering margins in our Nike Direct business. I'm sorry, that's a separate line. So gross margin decreased because of elevated freight and logistics. That'll improve. That should actually improve. Next, margin declined because of higher markdowns. Fascinating. That's really interesting because in the Q2 report, even in the Q2 report, they talk about partially offset by strategic pricing. That's a sign you don't have pricing power. When companies are saying, oh, we're being strategic about our pricing. Oh, we're doing, heavy markdowns to get our inventory out. I actually don't think it's Nike that has as much pricing power. I would say Lulu probably has a lot more, although reading the Dick's report could be illuminating to get some insight into that. We might have to do Lulu again. All right, let's look at the closing bell here. And let's hop on over to here.
Improvement stocks are doing really well, but there are a lot of winners out there. Best performing subgroup now is computer and electronics retail, which shows you But a lot of the tech stocks are rebounding today.
That is true, although Best Buy is a huge part of that
Yeah.
particular subsector, and that is very strong. Consumer-related is doing okay. We'll take a look at that in a second. Actually, relatively strong day in terms of the breadth of the market, more than 2-to-1 advancing to declining volumes. Definitely not an overwhelming buying stampede, but certainly pretty strong as the market levitates here. The S&P, again, over 4,000. We have not closed above there on this rally since October. Take a look at consumer discretionary relative to consumer staples over the last 6 months. This is the equal weighted versions, neck and neck. Actually, discretionary now outperforming. On a year-to-date basis, staples is trouncing discretionary. But there's been a little bit of traction here in the consumer cyclicals, and that's been, reflecting what we were talking about before, Sarah, about
Keep in mind, we do have earnings coming up here shortly, and within the next 1 minute to 6 minutes. We have HP, Autodesk, and Nordstrom. So we'll be looking at those.
Being open in the U.S., and so maybe it has a date with 20. That's been about the bottom of the range for the year, Sarah.
Thanks, Mike. As we head into the close, up 400 points right now on the Dow Jones Industrial Average. Almost every Dow stock is higher. It's Home Depot, United Health, and Caterpillar that are adding the most to the Dow's rally. The only losers today are Amgen, Disney giving a little back from yesterday, and Boeing, which is barely lower. S&P 500 is up 1.4%, which means it's now up 1% for the week. So we erased yesterday's losses and then some. NASDAQ comp up 1.4%. You've got every sector closing out in the green. So overwhelmingly positive day. Bonds are catching a bid. The dollar is weaker. All very supportive right now. And some of those big cap tech stocks are rebounding, like Apple, Nvidia, Microsoft, and Alphabet in a big way. There goes the bell. That's it for me on Closing Bell, everyone. Now I'll send it into overtime with Scott Wapner.
Sarah, thank you very much. And welcome, everybody, to Overtime. I'm Scott Wapner. You just heard the bells. We are just getting started from Post 9 here at the New York Stock Exchange. SoFi's Liz Young will be with me in just a bit. Whether she thinks today's rally reignites a run for stocks into the end of the year, that is where we begin today with our talk of the tape. The push.
She gets a lot of press here on CNBC. So again, we've got Nordstrom, Autodesk, and the HP coming out here any moment. Autodesk is implying a 5% move, HP a 4.4% move, Nordstrom potentially an 11% move. Led certainly by this shift in retail that we're seeing, and Autodesk is out. EPS 1.7. The estimate was 1.71. Adjusted. What do we have here? Q4 adjusted EPS guide a little bit lower, 177 to 183 versus 182. Slight miss there on the guide for the midpoint being 1.8 versus 1.82. So forecast is definitely a miss. Let's see. OK's $5 billion share buyback authorization. Man, all these companies are buying back. I mean, it's smart to do when your stock is cheap that and in pain and uncertainty. That's when you do buybacks. EPS non-adjusted 91 cents. Again, we had a miss on adjusted by 1 cent and the guide missed by 2 cents. HP and Nordstrom not out yet. Let's see how Autodesk is moving on that. Autodesk down about 1.53% in after hours here. Not a big move. The company is certainly off its lows of what we've seen this summer. Seen a lot of companies sort of off their summer lows, but a lot of uncertainty still left in this market. Okay, waiting for HP and Nordstrom now. Let's hop on back over here.
Days where you close above it, and you're going to see the rules-based, non-discretionary funds come in to buy the market. So you will get at that point to 4,100, 4,150. What's also cooperating in this environment, and let's not lose sight of this, is fixed income. Fixed income, investment grade, high yield, municipal bonds, all trading very well right now. And underneath the surface of the market, I think there's something that's somewhat puzzling. If we are going to this period where we're going to see the potential for a hard landing economically, why are financials performing so well? Quarter to date, JP Morgan up 29%, Bank of America up 28%, Goldman Sachs up 31%, Citi, Wells Fargo up 18%. What is that telling you about balance sheets? Balance sheets for consumers and corporations must be in better shape than we're thinking.
But you're thinking that the
We'll see. I mean, I guess it's not a terrible point. I don't know that we're really expecting to see big bankruptcies like what we saw in the last recession. This is just a BS kind of recession we have to get through. Okay, forecast fiscal revenue for Autodesk coming in at a midpoint of 5. Midpoint guide was about 5.025. Q3 sales in line at 1.28. And fiscal year EPS guide with a midpoint of 6.59 versus the expectation of what looks like to be 6.61-ish. So tiny little misses there on Autodesk, but I mean, it's not terrible. Still waiting on HP and Nordstrom. That's going to be interesting. I've after Dell and Best Buy, I've been very curious about this potential for a bottoming of the PC market. And I think there could be a potential opportunity to make some trades there. If I look at HP stock, HP has... let's see here. Wait. I didn't know. HP? Did they split? Hold on. Yeah, no, this is HP. This is, yeah, there we go. Okay, HPQ. There we go. Get the ticker symbol right, Kevin. There we go. Okay, that's what I thought. Okay, so here's HP. This is the week chart. So let's go to the day so we can just see the year here. Here is your 2022 start right around $37. You're sitting at 29. You're off the lows from 24. Certainly had that sort of Tesla-like downtrend here, except Tesla's still on it, and it has gotten off that roller coaster. Autodesk now down about 4% after this tiny little miss here. Nordstrom comes in with a beat. Oh my gosh, revenue $3.55 billion versus $3.51. EPS adjusted coming in at 20 cents versus 13. That's almost twice as much as expected. That's a really nice beat there by Nordstrom. Wow. These consumers just don't stop. Nordstrom up about 2% right now. I wouldn't be surprised to see that move larger depending on what other kind of data we get here. All right. Let's see here. That's Nordstrom. Nordstrom, again, adjusted EPS 20 cents. Trying to see if there's any forecast. Nordstrom sees fiscal year revenue 5 to 7% of an increase. It's good. And more of a forecast would be nice. No HP yet, so still waiting for Nordstrom. Okay, here we go. Adjusted full year EPS expected to be 245 at the midpoint versus the 237 expected. That's good. Again, good numbers here from retail. Of course, Nordstrom in a weird way down 1% now. But then again, earnings is like the hardest thing in the world to trade because you could be right on everything and it could still go down. Let's see here. Nordstrom Q3 EPS. Okay, what happened here? The non-adjusted EPS was a mess. What happened here? See, the adjusted EPS came in at 20 cents versus 13 expected, but the non-adjusted EPS, so the GAAP EPS came in at a 13-cent loss, missing a 14-cent estimate. Aha. Okay, so this is going to be a little bit more of a blurry report to understand. Why was there such a difference between GAAP and adjusted? All right, while we wait for HP, let's see if we can figure it out. So we will go to Investor Relations, Nordstrom. Let's see. And then I'm going to have HP ready to go. Press room. I think there we go. All right. Nordstrom coming up. Let's see what we have. Let's see if Nordstrom has pricing power. Like Dick's Sporting Goods. Third quarter net loss of 20 mil. loss of 13 cents per share compared to their adjusted of 20 cents. Excluding a supply chain technology and impairment charge, the company reported an adjusted earnings of 20 cents. So this is what I was talking about this morning. I can't remember if it was in the course member live or in the public live. And remember to use the 60% off coupon, by the way. But in one of them, I was talking about how I'm very concerned about fulfillment and how much money these companies spend on their supply chain management. Net sales decreased. Banner net sales. What are banner net sales? 3.4%. Doesn't sound good. Okay. Nordstrom Rack decreased 1.9%. Consumer demand decelerated in late June. Oh, they saw it early, or they had the deceleration early, because most companies really started seeing, at least from my memory here, it seems like most of them started seeing a deceleration starting in about October. So the fact that they started seeing a deceleration in late June suggests that their deceleration came earlier. Which, does that mean it recovers earlier or it's less essential, right? You know, I suspect it's probably the less essential part. You know, are people going to Macy's, as an example? Right-sizing our inventory. Customers continue to respond to newness and fashion, blah, blah, blah. Doesn't look like we've got pricing power at Nordstrom. Reducing store fulfillment for Nordstrom Rack digital orders, sunsetting Trunk Club. Digital sales. Whoa. Oh, gosh. Imagine, and then consider inflation as well. This is terrible. Digital sales down 16.4%. But then again, they talk about the timing of this anniversary sale, which had about a 3% impact. Yeah, but 3%, dude, you're down 16% from last year. And it's fine. 2021 was a great year. Like, most people's income is down in 2022 compared to 2021, whether that's through the wealth effect of, stocks or real estate or whatever it might be. Okay. Let's see. What's her outlook here? Revenue growth, including retail sales and card revenues, of 5 to 7%. That's for fiscal 2022, but that's what they're in right now, right? Let's see here. It's going to. Let's see. This is third quarter. Okay, third quarter 22. So they're in line with the calendar. Yeah, here you could see that net sales declined year over year. Credit card revenues up about, what is that? About 10%. SG&A barely moved, which is good. Where's costs of revenue? Costs of sales related to buying and occupancy costs. Okay. Exactly the same as last year. You got exactly the same number. Okay. Still no HP, by the way, out. Oh, interesting. Inventory is definitely up. They're bragging about their inventory management, but let's see what we got here. 2878 divided by 2289. This is not as good of a report as thought. Yeah, their inventory is up about 25%. Okay. Then we have the cash flow statement. So now all of a sudden, net cash provided by operating activities, still cash flow positive, unless you take out the capital expenditures. Now your actual free cash flow is negative. Negative free cash flow. And this might be where we see that charge, that impairment, right of use amortization, asset impairment. This is probably that supply chain issue they were talking about. We can find out more details about that. Anyway, to me, here we go. Gross profit as a percentage of net sales of 33.2% decreased 190 basis points, primarily due to, there it is, folks, higher markdown rates. The company incurred approximately $100 million of incremental markdowns out of the approximately $200 million expected in the second half. Okay, well, I mean, that aligns, $100 million in the quarter, $200 million in the second half. But that's interesting because what's the revenue? Revenue is net sales of $3.4 billion in a quarter, and 100 of it was markdowns. 100. It could have been 100 more is another way to look at it, right? But that's only 100 million markdowns. I mean, that's not actually that big, is it? 100 divided by 3,433. Yeah, it's about 3%. Interesting. Is that all it takes to get people to buy stuff? But I guess what that tells you is 3% while inflation is 8%. Does that potentially imply an 11% real price decline, right? Because if the product was $100 and it kept pace with inflation, it should be $108. But they actually had to move it to $97. So that means 97 divided by 108. Yeah, about 10.2%. Interesting. That's how you're getting your discounts. And so that, my friends, is probably why Nordstrom's down 4.9%. HP is still not out. Autodesk is not doing great. Oh, HP just out. Oh, wow. 4,000 to 6,000 job cuts by the end of 2025. HP sees, Q1 adjusted EPS 70 to 80. That midpoint is 75 versus the 86 expected. That's an oopsie doopsies. HP revenue declines 11% as PC demand wanes. Okay, that's fine for the last quarter. What I want to discover is now in Q4, are we potentially getting out of that hole, right? So HP sales down 11%, or revenue down 11%. Their forecast is actually for personal systems kind of on point, 10.27 versus 10.28, potentially reiterating that thesis that HP or that PC sales might be bottoming or in the bottoming process. HP down about 5% now. Oh my gosh, there's just so many updates. They're announcing a restructuring plan called Future Ready, and this includes 4,000 to 6,000 job layoffs. Operating margin of 5.2%. Doesn't sound like a lot of pricing power. Announces dividend increase, Future Ready transformation, gross operating margin of 7.7% versus 7.72 expected. Raises quarterly dividend 5% to 26.25 cents a share. The estimate was 28, so the dividend actually missed. Adjusted EPS misses. Forecast on adjusted EPS misses, 70 cents versus 80 cents. Yikes. About 10% of the workforce being cut. Layoffs with PC demand slump stretching into next year. Well, there you go. I guess not. We think it's prudent not to assume the market will turn during 2023. Yoicks. Dell also suggested a lull in PC buying this year would continue after a surge early in the pandemic. Oh, that's not great. Ongoing macroeconomic factors. The results come a month after data showed the PC demand, that PC demand in October slid at its fastest pace in more than 2 decades. Doesn't look like they're actually expecting it to end anytime soon. So never mind that thesis for now. I still want to look at their actual reports. But that's one that I'm paying attention to. That's a 10% workforce cut. Wow. More than 1/3 of Twitter's top 100 clients have not advertised in the platform or on the platform in the last 2 weeks. That's probably not going to run well for Tesla. Remember, Tesla's trading as basically your short for Twitter at this point. Crazy. All right. Well, here we have some insights. Nordstrom, HP, Autodesk worth taking a peek. Yeah, okay, nothing else other than what we already talked about. Goldman sees 10-year yield of 4% or more through 2024. Wow. Be an opportunity to Supreme Court clears House panel to get Trump tax returns? No way. There are going to be so many leaks. Oh my gosh, the leaks are going to be crazy. Wow, the House Ways and Means Committee is going to get the returns. Oh, you know that's going to leak. Oh my gosh, that's crazy. That's going to be fascinating. All right, there you have it. Check out that coupon. Link down below. We'll see you hopefully in the course live streams. See you then. And if you have questions about bundling up, just email kevin@mekevin.com. Thanks, bye.